All right, check, check, radio check. I want to welcome all of you to our weekly call. I want to welcome Diane and Mike, currently Maryland residents moving to Delaware. Just got back from their cruise, so welcome home and rest up. It's been a little while, so we missed February, and then last month we were able to do a rear view mirror look of March. And even though this is May, we're doing a rear view mirror look for April and the data for the markets. So, this is something I just find it's a good way for us to sort of do a pulse check, so that we're not really caught up in, we can tend to have a myopic approach when we're listening to the talking heads on TV, and we're very in the moment how the markets look. This gives us a chance to sort of play Monday day quarterback and going, are we on course? Is there any reason to adjust? Any reason to panic or to get more money into the markets? So without further ado, I want to thank everybody that's on this call. If you've not been on this call in the past, if you're watching a live stream on LinkedIn, we would encourage you to sit back, listen, take notes. If you have questions, please reach out to us. Happy to help. So without further ado, let's get into let's see why it's not, there we go. So, the April, right? This is a month overview snapshot of the equities markets, and then they're color coded. And on the surface, we look at and we go, "Ooh, April was a little bit of a challenge because most of the indices are negative. The only one that was positive was commodity." And commodities, that makes sense because it's typically heavily laden with oils, right? The petroleum products. So I've seen the price of barrel of oil going up. So people are starting to move some money into to commodities in anticipation that gas prices might be higher in the future. We have a lot of activity globally going on that could certainly influence that. So again, political comments aside, it's not where I like to put money, but just understand that that's what that's telling us. But the rest of the indices for the month of April, nobody really fared well. But 1 month does not a market make. You've heard me say that in the past. I believe that. We have to be steady, we have to be consistent, and then we have to be diversified. So as we start to look at the year, well, the year is a little better. Commodities still have beat out all other asset classes. But then the next is the S&P, right? Almost at 6% year to date, not horrible. And then the light blue is the European total return, which is the Europe's version of the S&P. The rest of the indices, not so much. And then the laggard is real estate, right? So the brown real estate is continuing to get pummeled, especially commercial real estate. I think a lot of these buildings, there's a lot of empty space in these big cities. And it's just not where I think the smart money is flowing, and that's evident by the return of on this chart. Now, the next chart is the three wise men, right? And we typically, it's just a pulse check. What are we seeing? And it shows that, hey, listen, that the bull bear indicator, the top one, relative strength index, then we have the MACD, and then the convergence divergence line, right? So the three indices, when they cross, right, then tends to be a forecaster for where do we think markets are going. And, I am not a gloom and doom kind of person. And remember, this is for April. So as we look at this now and we say, hey, if we had reacted right when this crossed over, we would have missed some of the activity that has been demonstrated right now of late in both the S&P and the NASDAQ and the Dow. So this is why don't use these calls as any type of day-to-day monitoring. They're just observations to say, hey, what direction do we see, and are we positioned or are we strategizing in a way to benefit from it? So a lot of what we do at Professional Planning Services is promote the reduction of risk, to be able to have the ability to have alternatives to, hey, if we want to be in equities, but if we can start to achieve some of the upside potential without some of the downside risk, how does that look? So overall, nothing overly alarming here, other than we do have a red line. We do have some signals that there are headwinds ahead. When will they manifest themselves? I don't know, but I do know that we are in an election year. That's the first thing. Secondly, we have China on the radar, right? They're rattling their sabers, and all the things that we see over there, both with Taiwan and the Philippines, right? So we have that. You have the ongoing conflict in Russia in the invasion of Ukraine. So that's also and of course the horrific attacks October 7th, and now Israel is on the world stage. That coupled with political unrest here in the United States, right, on these college campuses, the anti-Semitic messaging, the just all the nonsense, for lack of a better term, that I see going on right now, is causing, I think, warranted concern. And so we constantly watch this stuff. So, that coupled with, we have higher inflation, right? We have unemployment rates that are starting to creep up. You have a lot of things that are on the radar. So when I see a red line here, I'm just saying heads up, right? If we can slowly start to dial back some of the risk of these portfolios, it will help us prevent from taking a bath. So, we could have a flash crash. You see this over here, this 2019, this happened very quickly when COVID happened, right? Something pops off, we could see something similarly. And remember, there was a red line there. I don't know what the future holds, but right now for the month of May, things seem to be calm. So don't panic, but just a heads up. All right. So now when I come to, when I come to the income components, right? If your portfolio, you're retired, you're basing your portfolio, and the theory is that you've generated or built a portfolio to generate income, how has that been performing, and where should your money be? Well, nothing is really done well. So this is problematic because, I was just on the phone call with somebody today, and they said, yeah, they Googled their return. They're just entering into this sort of thought process. They came to my Social Security seminar. They think they've got a plan, but what I heard was, and this is why you have to be careful doing it yourself. Oh, I went online and I saw that the 4% is the withdrawal rate. Be careful with that, because that rate has already been disproven. Right? If you draw too quickly from an acquired amount of assets, you will start to see that not only do you have a snowball melting, right? So you put it on the parking lot, it's 80 degrees, it's an August hot day, and it's melting. But if you're not careful, you could now run over with a hair dryer and start to put that on there. That's the 4% rule. You're accelerating the depletion of that account. So when we look at these things and we build portfolios to generate income, right, that they have to do what they're designed to do, and that's create income. But if you turn around and you keep rating it because you're following a rule that really was not custom designed for you, it could be problematic. And so here for the year to date, we have the same problem, right? If you needed for whatever, you have $1 million in your portfolio, you're getting Social Security, and let's say that that's $35,000 a year combined for the household, right? So you got some of your income needs met, but you needed 70,000 and you only got 35,000, not taking taxes into consideration. We need 3.5 to 4% to be able to live and maintain lifestyle here in New Jersey. Well, if that's the case, 4% on $1 million, that's 40 grand a year. But if you're in the market and now you're now getting negatives on your income portfolio, we're having to eat into that principal, and that's the cause for concern. So when you're designing this stuff and when you're dealing with professionals and you're starting to work on the income that needs to be in your portfolio, it's about the income in retirement, not about some rule that is arbitrary and maybe not applicable to you. Again, this is just an observation that the income portfolios are down, right? So where do we put our money? And that's where having strategic plays. I tend to lean towards structured notes, right? That these vehicles are my bond alternatives. They can generate income. A dividend income basket may be something where it's established. Yes, we're in equities, but the equities are designed to give us income. This combination of our strategy allows us to be able to sort of weather the storms when I see charts like this. So that's my little ta-da. And then lastly, I'm going to go into what does this look like? And we have a red line on the bond markets, right? So when we look at income, we've now started to slowly drift downward, and that's where the downward pressure is coming on. So again, nothing gloom and doom, nothing, but it's just be aware that being in investing, we don't panic when we start to see some sell off, and we also don't want to arbitrarily just take more risks than we need to be able to try and get to that rate of return that you feel you need for your portfolio. So lastly, I'm just going to bring up the recession probability analytics tool. We're still hovering around 58, 60%. It's off a little bit, and this was for April. So again, sky's not falling. I'm not Chicken Little. I'm not saying, hey, be careful, but we are above 50 percentile. It's on the radar. So, this is overall, I think it's okay news. We're not high-fiving, but just if you got questions, you got concerns, you want guidance, you need clarification on your portfolio, happy to have a conversation with you. Let me know. And then without further ado, this was a quick call this week, but I am always here, professional planning services, my staff. Things are, if we can do anything for you, if you want to come to one of our upcoming events, please let us know. You're more than welcome. So without further ado, my disclosures.